Did you know that 100% bonus depreciation is back? Well, here's what you need to do right now. Most real estate investors are going to wrap up their 2025 taxes and leave tens of thousands of dollars on the table. Not because of a bad deal, not because of a bad market, but because they don't know the tax code just changed in their favor in a major way. Congress permanently reinstated a 100% bonus depreciation for qualified properties acquired after January 19th of 25. That's not a temporary break. It's not a phase in. It's the full deduction in the year you place the asset in service. So if you're investing in single family rentals or small multifamily right now, you're not accounting for this. Well, you're paying taxes that you don't owe. This video is going to break it down so you understand exactly what changed, why it matters, and how to use it without getting sideways with the IRS. Do me a favor, if you're getting value from this, hit the like button, subscribe to the channel, ring the notification bell so you don't miss the next video made for serious operators. Here's a quick background on me. I did 35 years in the Air Force, 13 years as a police officer. I'm a former mayor in a Jersey town. I'm an active real estate investor focused on single family and small multifamily. I mentor veterans in real estate and founded a low-cost investor-focused property management company. Here's what most investors believe about depreciation. They think it's a slow drip. You buy a property, you depreciate the structure over 27 and a half years. Every year you get a small amount of a deduction that's going to offset a portion of your rental income. That's the standard model, and that's okay. And for a long time, that's how the game was played. And most investors accepted it and moved on. Then bonus depreciation came along. Congress introduced it to stimulate the environment and the economy. The idea here was straightforward. Instead of waiting 27 and a half years to deduct the full cost of certain components of your property, you could accelerate that in one deduction in 1 year, 100%, year one, under the right conditions. Investors who understood this used it aggressively. Investors who didn't kept doing things the slow way, never really asked their CPA, and the CPA wasn't really talking about it. Then the phase-out started. Under the Tax Cuts and Jobs Act in 2017, bonus depreciation was set at 100% through 2022. After that, it started stepping down, 80% in 23, 60% in 24, 40% in 25 under the old schedule. Investors focused factoring in on the fade. Some stopped doing cost segregation studies because the math got tight. The window was closing and most people assumed it was gone for good. And here's where the real damage happened. Investors who had built acquisition strategies around 100% bonus depreciation started adjusting their models. Some backed off value add projects, some skipped cost segregation entirely because paying for a study when you're only getting 60 cents on the dollar didn't really pencil out. Others bought deals expecting one tax outcome and got a different one mid-year because the rules changed. The tax tail was wagging the investment dog. That's the mistake here, and it's a real one. Tax strategy in real estate isn't just an accountant's job. It's part of the acquisition decision. When you don't understand what's really going on, you leave money on the table or you structure deals incorrectly and create problems for yourself down the road. So here's the turning point. In early 2025, Congress passed legislation that permanently reinstated 100% bonus depreciation for qualified properties placed in service after January 19th, 25. Not a temporary extension. This is now permanent law. The phase down schedule is gone. Full deduction is back. That changes the math on a lot of deals that might not have penciled out before. If you're a veteran or first responder thinking about real estate right now, this is the environment you're walking into. And the investors who know about this are already adjusting their acquisition criteria accordingly. If you're a veteran looking to build real estate wealth, I want to point you to the War Room with David BRRRR. Dave's a Marine vet. He's one of the most knowledgeable people that I know in real estate investing. And the War Room is a community built for people like us. It's a resource, not a pitch. So go check it out. The link is in the description. If individual coaching makes more sense for you where you are right now, visit budevans.com and let's talk. Let's get into the execution layer here because bonus depreciation doesn't just apply to the entire purchase price of a rental property. That's a common misunderstanding, and it's how people get into trouble. And here is what actually happens. When you buy a rental property, the cost has to be broken down into components. The land is not depreciable at all. The structure itself gets depreciated over 27 and a half years normally for residential real estate under the standard depreciation. But certain components of the property, things like appliances, flooring, fixtures, landscaping, certain personal property and qualifying land improvements can be depreciated on a much faster schedule, 5 years, 7 years, 15 years. These are all components that are eligible for bonus depreciation. To identify some of these components, though, you have to assign cost to them. So you have to do something called a cost segregation analysis by hiring a cost segregation engineer. They walk the property and produce a study that's going to reallocate your costs for the lifelong structure and categorize it into shorter categories. On a $300,000 rental house, you might identify $50,000 to $80,000 in a 5-year and 15-year property. Under the old phase down, that deduction was shrinking. At 100% bonus depreciation, you take the entire amount in year one. That's significant. Depending on your tax situation, that could wipe out an entire year's worth of W-2 income or offset your gains from another property sale. It's not a loophole. That's the tax code working exactly how Congress intended it to work. You're playing by the rules. Here's the mistake that trips people up, though. They buy the property, they don't do a cost segregation, and they just depreciate the whole thing over 27 and a half years in a standard way. They never identify the accelerated depreciation components. They pay more tax than they owe because they never asked the question. And once that first year return is filed, without it, catching up requires amending returns, which is a hassle, and it's going to cost you more. The other mistake here is assuming bonus depreciation alone makes a deal worth it. It doesn't. The deal has to stand on its own. It's got to have cash flow and equity fundamentals first. Tax strategy is a multiplier on a good deal. It's not a rescue plan for a bad one. So here's what proper execution actually looks like. You're going to identify the property that has real investment merit, right? It's a decent rent to value ratio, a market with stable or growing demand, manageable deferred maintenance. You run your standard acquisition analysis. The deal works on the numbers. Then you layer in cost segregation analysis. You engage a qualified engineer before or right after closing. You get the study completed. You work with a CPA who actually gives a shit, number one, and understands real estate tax law. He's not just a general tax prep guy. You make sure your depreciation schedule reflects the segregated costs. You have to file correctly. Last piece of this is the passive activity rules. For most investors with W-2 jobs, rental income and losses are passive. There are income limits on how much passive loss you can deduct against ordinary income. If you're above $150,000 in modified adjusted gross income, the losses get suspended and carry forward. Real estate professionals under IRS definition can deduct them currently, but that status has specific hour requirements. You need to know where you stand before you actually assume a big depreciation deduction is going to offset your W-2 income directly. This is a conversation you got to have with your CPA before you close, not after. So as always, here's a checklist you can actually use. Number one, confirm that your property qualifies. The asset has to be placed in service after January 19th of 25 to fall under the 100% depreciation rule. Engage a cost segregation engineer. Do it before or immediately after you close. Waiting until tax season is too late to optimize the study. Get a CPA who knows what they're doing and they know real estate. General tax preparers are going to miss cost segregation opportunities. You need someone who actually works with real estate investors. Understand passive activity rules before you close. Know your modified adjusted gross income and whether or not you qualify for real estate professional status. This will determine how much you can use on the deductions. Do not let tax strategy drive bad acquisitions. The deal has to work on cash flow and fundamentals first. Tax treatment is a layer on top of a good deal, not a substitute for a bad one. Run your numbers both ways. Model the deal with and without bonus depreciation. Know your delta. Know exactly what you're leaving on the table if you don't do the study. Document everything. Cost segregation studies, invoices, purchase agreements, and placed in service dates. If the IRS ever questions your depreciation schedule, the documentation is your defense. Review your prior year returns. If you purchased qualifying properties in 2025 and didn't take bonus depreciation, talk to your CPA about whether or not amended returns will make sense. Hey, if you got something out of this, hit the like button, subscribe to the channel, ring that notification bell so there's more content like this coming and you really don't want to miss it. Thanks for watching. I'm Bud Evans. Aim high, execute fast, and I'll see you on the next one.